Okay, good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. My name is Benjamin Goh, the head of research and investor education here at SIAS. And with me is, of course, our senior technical analyst, Sunny. So we'll be talking to you about what's been happening over the weekend as well as the week going forward. Before we get there, the disclaimer, as usual, is that SIAS is a registered charity. We're not licensed by NASDAQ. So whatever that we talk about today cannot be misconstrued as a recommendation, especially if we are talking about specific stocks. So do see a licensed financial professional before taking any kind of action in the capital markets. All right, we do have the upcoming SIAS. This is on the weekend, on the evening of 31st of June on Wednesday. Just to let you guys know, and because we're in the habit of oversharing, or at least I am, I'm going to be on holiday in somewhere else in in a different part of the world, and so will Sunny. So we're gonna get a couple of AI presenters to do the show. No, not really. We will actually be logging in from our respective hotels. And that's how much we love doing the show. Okay, moving on. The QR code for the SIAS membership. So again, a little bit of selling here, $1 per month, $12 per year, much cheaper than an upsized Burger King meal, I think. So definitely one of the best benefits here is to get subsidized rate for some of the paid workshops, and of course to be able to join our monthly SIAS session. Now, I've got only 3 slides, but I just want to bring to the fore a couple of observations that we've been seeing based on the analytics that's been coming out. As you can see, the tech sector is on fire, so riding far ahead, especially for NVIDIA, which is driving most of the, hardware requirements of the AI age. If you look at the top 5 S&P 500 stocks by market cap, these will be Apple, Microsoft, Alphabet, Amazon, and NVIDIA. Except for Amazon, as you can see, the rest of the companies are very strictly in the tech space. Amazon is, of course, kind of a blend of two, since they've got the Amazon Web Services. But the challenge here is that the combination, or rather the total market cap of all these 5 companies now stands at $8.97 trillion US dollars, and this represents close to 24.2% of the S&P 500. This is the highest reading since the year 2000. During that point in time, the average reading for the top 5 companies by market cap is about 14.3%. So the current number of 24.2% is 3 standard deviations away from the mean. Yeah, so 3 standard deviations. If you guys remember your normal distribution and your statistics, this is like, what is it, 1%, less than 1%? I can't really remember, but it is, like hardly ever happens, right? And again, this is highest reading since the year 2000. Now, this is not normal, okay? And why is this a problem? Because if we take a look at the historical data and we cut up the what you call the percentage weight of the top 5 companies, and we put it into the different quintiles. So quintiles, that means the bottom 20%, the next 20%, all the way to the highest top 20%. As you can see, we're now in quintile 5 since the percentage weight is so high. What has been happening is that as we look at the calculations going forward, the 12 months return is actually the lowest when the top 5 companies make up such a huge percentage of the S&P 500. So based on the data that we've seen, the forward 12 months return on average basis is expected to be 5.88%. Now, anecdotally, or I guess based on common sense, this kind of makes sense, because the only way the S&P 500 can do better is simply because the top 5 companies can go and chung some more. But the problem is the top 5 companies, the technology stocks, have already chung so much, right? Pardon my French. It's actually hard to move the needle on the overall S&P 500 simply because they're now so expensive. So the S&P 500 as a whole is not expected to do that great going forward in the next 12 months. So historically, higher concentration has led to lower forward returns for the S&P 500. Now, the other thing I want to talk about is the relative strength. We are going to compare the S&P 500 equal weighted index versus the S&P 500 market weighted index. Now, the ticker for the equal weighted index is SPW. The usual one that we normally look at, the market weighted version S&P 500 is SPX, and this is actually a topic that we've spoken about in our Money FM interview every Friday. If we take the value of the SPW divided by the SPX, we get a number of 1.3403. Now, the absolute number itself is, doesn't really matter, it's just rubbish. But what is important is, of course, you look at the chart. All right, so the chart has taken a huge beating recently. So you look at this downtrend in the last few months. What that means is that the SPW, which is the equal weighted one, is underperforming the SPX, which is the market weighted one, which is, of course, ties in with our previous chart that says that the top 5 companies in the SPX is now worth, 24% of the entire index. So the equal weighted version of the SPX has been underperforming the market weighted by more than 10% in the last 3 months. Now, again, historically speaking, looking at the data, this typically happens only during or in or around a US recession. And again, we're looking at data that goes all the way to 1990. Right, the last 33 years, 34 years. If we look at this relative strength and we calculate the rate of change for all you TA people out there, the ROC of the relative strength is now at minus 9.02%. This is more extreme than all but 2 instances of recessions in the last 35 years. So at least on this measure, we are being told by the market that we are already in a recession. Now, obviously, we wouldn't know until a couple of quarters later. That's when the economists will look at a vast, diversity of economic indicators and then call the recession. So usually we don't know whether we're in a recession or not. But again, this is kind of in the ballpark of what we've been saying since the early part, or rather the beginning of this year, that heading into the second half of 2023 is going to be rough. All right. So the takeaway here is that, we could be already in a US recession. Good stuff. All right, I'm going to leave it here, and Sunny is going to start talking about the debt ceiling, I believe, and a couple of charts.
Okay. Thank you, Ben. So just now we saw, Ben, the last slide of it, the rate of change is like one of the lowest since the COVID period. So that is also much in line with some of the research I managed to read and catch up over the weekend. I read one of the research saying that only 29 of the S&P 500 companies are outperforming the index. So that more or less ties in with what Benjamin mentioned earlier, where only like 25%, the top 20 few companies in the S&P 500 are actually carrying the weight of the S&P 500 weighted index. So the rate of change also reflects that we are in a bad state, and that is comparable to what happened, or even worse than what was happening in COVID period, as well as the 2008 financial crisis and even the dot-com bubble. So these are the signs, these are the symptoms that are reflecting in the data that is coming out pre-recession, or even maybe we are already in a recession. So if we look at the CME Fed Watch tool, which is the Fed Fund Rates pricing of a probability of an increase in the Fed Fund price, the interest rates, the current latest reading is at about 79.28% that we will have an unchanged or a pause in the Fed FOMC meeting decision. On the other hand, we also have a 20% chance that there might be a 25 basis point increase in the 14th of June meeting. So what happened here was that on the Friday itself, which was a Visa Day holiday on our local market, actually of the US session on Friday, 2 of the Fed voting officials actually comes out and say that they are in support of a rate pause for the round of June to better assess the data. So with that, I'll move on to the economic data for for this week. So let me go through the data last week first. Front and center, we have the Friday non-farm payroll data, which come in at 3.7%. That's the unemployment rate, which was a tick up from the previous month reading of April 3.4%, and also above the market consensus or economists' estimate of 3.5%. So this is a welcome news. This actually allows the Fed to have more room to wiggle and to have more say that they should actually pause the rate hike to access the data because unemployment rate is rising. However, it's not so bad in the sense that the economy is going to tank very hard. So this is actually a welcome number, or a number that the market at least is focusing on as of the performance of the index, the major US index last week. Non-farm payroll number was also pretty outstanding, coming in at 339,000 compared to the revised upward numbers of the previous month of 294,000, and that is like almost double of this week, or this month number is almost double of what the economists are actually thinking at 190,000. So very strong kind of payroll data, and there's also an uptick in the unemployment rate. So both, it sort of satisfies both the people or the segment of the market that wants to look at a Fed pausing the rate hike, as well as not crashing the economy or economy going to a deep recession. So that is the main data that was coming out last week on Friday. This week, we are just looking at the service PMI data, which is expected to come in at 52.3 based on economists' estimate versus the previous reading of 51.9. Okay, so last week, we also have the manufacturing PMI data on Thursday, which is at 46.9, which is 0.1 point below consensus and 0.2 point below the previous April month reading. So the service PMI data might also give us some insights into how the economy will be performing in the coming few months. Okay, so the consensus 52.3 and the previous reading 51.9. So I want to just preempt everyone ahead on the 13th of June. That will be the headline inflation rate number that will be coming out, previously reading at 0.4. So we are looking at a forecast of at least 0.1% lower, so that it sort of still hold the stance or the thesis that at least the inflation rate is under control and not spiking back upwards. Core inflation rate, previous reading at 5.5, is coming. It's expected to come in at 5.4%, also a bit of a downtick from the previous month reading. So this is the main data that will come in before the June 14th decision of the FOMC meeting. Okay, towards the earnings side, I think this week, not much of the earnings as we go into the end of the earnings season. So next Monday, we have Oracle that may be reporting data. So this might be the company results that might sway the market a little bit. On the Singapore side, maybe the NIO, the electric EV maker, will be announcing their business updates and as well as their Singapore earnings for Q1 on June the 9th, on Friday. So do look out for that result after market close, and we might cover that a bit more in details next week. So I'll go forward to the index now. So this is the Dow Jones index, a big green bar. So this is there's two things that's driving this green bar. One is the debt ceiling deal that was struck. The other was the point that I mentioned just now. Two Fed officials actually is in favor of a rate pause for the 14th of June FOMC meeting. So markets actually take that pretty much very well. And of course, on top of that, the non-farm payroll data also helped push the market up a little. So the Dow Jones index actually up 2.12% or 700 points, which is a very positive result on Friday. Technically, looking at the indicators, we can see that the RSI is pushing up above the 50-point mark already, and now reading at 58.47. So the 58.47 reading is actually a pretty healthy reading, and then that means that there may be still some room for the index to push higher before it reach the overbought territory of about the 70-point mark. So over here, I think the resistance level to watch out for will still be the triple top formation that you see over here. Since the start of the year, that is around the level of 34,281 points. That will be the key resistance to watch for the Dow Jones index. The MACD indicator is also positive on last Friday at the reading of 20.40. We can also see the MACD line converging towards the signal lines, and it looks pretty close that the lines will likely breach the zero baseline in the next few weeks, and that also means that there's positive momentum in the Dow Jones index point right now. So with both the MACD and the RSI looking positive, and then we still have a bit of room to move before we hit the resistance level at 34,281. I think Dow Jones Index is going forward to look at a positive week in the next 1 or 2 weeks, at least before the FOMC meeting, which a lot of traders might want to price in a further chance of a rate pause here coming in on 14th of June. So this is the S&P 500. It looks a little bit overextended. We have a wedge over here somewhere around the April, May, or even the late of March period, and we have a breakout above that wedge period. So the latest reading on Friday on the S&P 500 is 4,282 points. The previous resistance that we have been talking about is this double top or even a triple top formation, which is around the 4,200 or 4,195 points. So the RSI reading similar to the Dow Jones Index at above 50. The S&P 500 is a bit slightly more bullish at 66 points. Shows that we have not even reached the overbought territory of 70 points yet. So that means that there might be still some room to push up the S&P slightly further higher before the FOMC meeting. And the next resistance level to watch out for, I will need to zoom out a little bit over here. That will be the 4,325 point level. And that level was actually the August high that you see last year. So this will be next level to watch out for the S&P 500. And overall, the MACD indicator is also a positive reading at 8.43. So that means that both the RSI and the MACD are telling us that the S&P 500 do still have some positive momentum inside the index points right now. So that's definitely the chances of it pushing higher is pretty high. And the next resistance level to watch out for would be 4,325, which was the August high last year. And naturally, the support level will be the prior resistance that we are watching, the 4,200 or 4,195 points, which will be a resistance turn support level to support the S&P 500 index going forward. Next will be the NASDAQ Composite Index. So NASDAQ Composite Index has been on a tear for the past 2 weeks or so, I would say. So this is the latest chart that we can see on the NASDAQ Composite Index. We have actually been testing the resistance level in August last year already, and that is around the level of, I believe, around the 13,219 points level. And last Friday closing, we are already above that at 13,240 points. Now we see a bit of consolidation over here during the April-May period of this year. And after that, we have a sort of a very convincing breakout. So the next resistance level to watch out for, if we are going to breach the August high, that would be a very high 14,600 point level, which is the March high that you saw last year. So the NASDAQ Composite, if it can consolidate above the 13,219 points level, this will provide a good support for the NASDAQ to jump further up and then create greater divergence away from the Dow Jones Index as well as the S&P 500. So the next target for the NASDAQ Composite Index may be the 14,600 level, which is quite a bit, about more than 1,000 points up above. And we are looking at at least the Dow Jones Index staying above the 13,219 points level, which was the August high that you see. On the indicator side, we have already go into the overbought territory for the RSI indicator. The latest reading at 73.11 is above the 70 point mark already. Hence, there may be a chance that traders want to reduce their exposure at this elevated kind of level. So do watch out for that. And if a pullback is going to happen, then the next support level, of course, naturally would be the resistance level that you see, the double or triple top level that you see year to date this year, which is around the 50 days moving average level of 12,300 points. And slightly above that, we also have a double bottom formation in the February and March period last year, and that's around the 12,555 points level. So this will provide two very good support levels for a re-entry into the NASDAQ Composite Index. So the MACD is at 56.52, so that's a positive reading. So there may still be positive momentum in the NASDAQ Composite Index. However, that RSI is actually contradicting that point because it has already triggered the overbought signal for the NASDAQ Composite Index. Next, let me just move to the STI index today. Today is up 1.62% on a Monday because Friday was a holiday and we have the outperformance on the US indices up about 2% on the Dow Jones Index. So STI is actually playing a catch-up. However, at this point level of 3,218 points, we are close to a few critical resistance level. Of course, that is the 50 days and the 200 days EMA level at 3,235 and 3,240. So this is where the near-term resistance for the STI index is going to be. STI index also have not breached the 50-point neutral mark of the of the RSI indicator, which means that momentum is still weak, and today's gap up or today's jump is only a one data point that we should be looking at, and not a trend that is going to sort of present itself on the chart yet. On the MACD indicator, we have a slight positive cross of the MACD line above the signal line, the latest reading at 0.20. So this might be what the MACD is saying, that this might be a chance of a reversal in the trend that we see since the beginning of April, where we see a downtrend during the April and May period towards June, and that this might be a reversal that's going to happen on the what the MACD indicator is likely to suggest. So we are still waiting for further confirmation from both the MACD and the RSI indicator to say that this is an uptrend. At least the RSI needs to be above the 50-point neutral mark, and the MACD readings needs to show that the MACD line is actually diverging away from the signal line towards the zero baseline. That would be a very much clearer signal that we are going into a short-term reversal upward. On the Hang Seng Index, we have talked about this support level, which was the March low, and then we have breached that last week, and then we have touched another support level. Now, this level, if I'm going to zoom out all the way, is actually the March low of last year, and that is around the level of 18,235 points level. As you can see, once we touch that level on Friday itself, and today market actually bounced up. So this is the entry point that I've been looking at for quite a bit of time on the Hang Seng Index. So the MACD indicator is also looking at the MACD line crossing above the signal line, somewhere going to happen in this week, I believe. So if that happens, that would be another positive sign that this is actually a rebound. There's going to be a sustained rebound for the Hang Seng Index. The RSI indicator has actually been before that breached the 30-point mark, which is the oversold territory of the RSI indicator. So the reading currently now at 45.05 is actually an uptick from the low that we saw on last Wednesday or Thursday. So this is also a positive sign, and I look forward to the RSI index crossing above the 50-point mark, and that would mean it will have sort of an accelerated momentum on the HSI index going forward. So with both the MACD and the RSI showing promising indication that this rebound is likely going to be sustained, I think this is a good entry point for the Hang Seng Index. And definitely the resistance to watch out for, first thing will be the 200 days moving average at 19,986 points. And if we are able to break above that, this could provide the next support for the Hang Seng Index to jump and retest year-to-date high around the 22,449 points level. Okay, so I thank you all for watching in this week weekly market review, and I hope to see you again next week on our next session.